Welcome to the deep dive. We spend a lot of time on this show breaking down public research.
Right, things like published articles and books.
Yeah, exactly. Things written for a general audience. But today we are unpacking an internal document, which means we get a totally unfiltered look at how the financial sausage is really made.
It's always fun when we get our hands on these.
Oh, absolutely. We have a producer's strategy memo for a daily financial broadcast called Bulls, Bears, and the Bell. And the date on this document is Wednesday, August 12th, 2026.
Which offers a really rare, basically frozen-in-time snapshot. I mean, this isn't what the analysts were telling the public after the fact. This is the live playbook.
Right, the behind-the-scenes instructions.
Exactly. The producer is instructing the anchors to keep the delivery staccato and urgent, to focus heavily on the mechanics of this massive institutional rotation that was happening that afternoon.
And the mission for this deep dive is to figure out why the institutional players were panicking behind the scenes on a day that, on paper looked like an absolute party.
It really did.
Because if you just glanced at the headline numbers for August 12, 2026, you would assume everyone on Wall Street was popping champagne.
Yeah, the divergence between the ticker tape and the actual strategy notes is staggering.
We are going to decode the massive contradiction in this market, what the smart money was actually doing with artificial intelligence, and how a completely squeezed consumer fits into all of this.
It is a masterclass in why headline numbers can be dangerously misleading.
Speaking of misleading headlines, the contradiction that immediately caught my eye happens in the after-hours trading session.
Oh, the tech drop.
Yeah. A major tech giant shatters its revenue expectations, announces a $60 billion stock buyback, and the market responds by punishing the stock. I really want to understand the actual financial gravity behind that.
Because on the surface, it makes zero sense.
None at all. To understand the punishment, though, I guess we have to look at the euphoria that preceded it. The strategy memo outlines a regular trading session that was just breaking historic psychological barriers.
Yeah, let's look at the broad numbers first.
Right. So the S&P 500 didn't just have a good day. It shattered the 5,600 mark for the first time, closing up over 1%.
Which is huge.
Right. And the Nasdaq Composite, which is heavily weighted toward tech, ended up deep in record territory. It soared past 18,600.
Even the Dow Jones, which had been the sort of sluggish anchor of the indices, closed in the green above 40,000.
So everything is up.
Everything. And you have to remember, when an index like the S&P 500 breaks around 100-level barrier like 5,600, it triggers a cascade of algorithmic buying.
Oh, so it's automated.
Exactly. Institutional trading models are programmed to view those round numbers as resistance levels.
Got it.
Once the market pushes through that ceiling, the algorithms interpret it as a momentum breakout and automatically deploy more capital.
So that 1% gain isn't just, retail investors feeling optimistic.
No, not at all. It's heavy, automated institutional money flooding the zone. Everything is flashing green with broad participation across the board.
If you check your retirement account at 40 ZPM, you feel fantastic.
You do. But then the closing bell rings, and the after-hours earnings drop from the company this memo literally refers to as the market maker.
We are talking about Nvidia, ticker NVDA.
Right. Nvidia reported their second quarter numbers, and the absolute figures were astronomical. They posted over $36 billion in revenue for a single quarter.
That is just massive.
It is. They beat the street's expectations on earnings per share, and they deployed a $60 billion stock buyback program.
Let's pause on that buyback for a second. $60 billion is roughly the entire gross domestic product of a mid-sized country.
Yeah, it's a staggering amount of capital to just hand back.
Mathematically, a buyback that large removes a massive amount of floating shares from the public market, right?
Definitely.
Which, theoretically, should artificially boost the value of the remaining shares.
Exactly. It creates a supply squeeze.
Yes.
Management is effectively telling the market, we generate so much free cash flow, and we think our own stock is the best asset on earth, so we are going to buy it ourselves.
Well,
it is usually seen as the ultimate signal of corporate confidence.
Which brings me back to my confusion. I mean, they crushed the revenue goal, they engineered a supply squeeze on their own stock, and yet shares fell over 3% in after-hours trading.
Yeah, the market reaction was brutal.
I am just having a hard time wrapping my head around the mechanics of that drop. It feels like paying off your mortgage in full and the bank lowering your credit score because they expected you to take out a second loan.
That's a great analogy.
Yeah.
But, the market doesn't care about the mortgage you just paid off.
Yeah.
It really only cares about your next 30 years of earning potential.
Right.
The memo touches on a concept called being priced to perfection. When investors were buying Nvidia leading up to the summer of 2026, they were not buying the $46 billion in current revenue.
What were they buying then?
They were buying a flawless, uninterrupted trajectory of hypergrowth. The valuation had stretched so far into the future that any data point suggesting the growth curve might flatten was treated as a fundamental breach of contract.
So what broke the contract? What did Nvidia say about the future that spooked the institutional money?
The forward guidance. Nvidia projected $54 billion in revenue for the third quarter.
Wait, but $54 billion is an $8 billion jump from the quarter they just crushed?
It is a massive absolute number, yes. But the rate of acceleration was slowing. Wall Street analysts had modeled a much steeper curve.
Ah, I see.
The memo notes this guidance was viewed as muted. Furthermore, management flagged lingering uncertainties regarding high-end chip trade restrictions in Asian markets.
We are talking about geopolitical export bans.
Exactly. If the U.S. government physically restricts a company from selling its most advanced processing units to a massive global market, that revenue valve is forcefully shut.
It doesn't matter how good the product is if it's legally barred from crossing a border.
Right. And the producer's notes ask the anchors to debate a very specific question on air. Is the AI capex peak finally in sight?
Break down that term for us because capex seems to be the linchpin of this entire panic.
CapEx stands for capital expenditures. For the past several years, the entire artificial intelligence boom was driven by a handful of mega-cap technology companies spending infinite amounts of money.
Their capex budgets.
Yes, they were spending those budgets to buy Nvidia hardware. They were stockpiling these chips to train massive AI models.
So the fear on Wall Street is pretty simple then. What happens if Meta, Google, and Microsoft decide they finally have enough chips?
Precisely. If the end buyer slows their purchasing, the entire hypergrowth thesis collapses. That is the peak.
So if institutional investors are suddenly terrified that the tech giants are done buying hardware, that capital doesn't just evaporate. It finds a new home.
Money always goes somewhere.
And looking at where the money flowed during this specific session reveals a next phase of this technological cycle. We see a massive rotation out of the companies making the chips and a huge influx of capital into the companies building the physical infrastructure to house them.
The market is maturing. It is basically pivoting away from the manufacturer and rewarding the landlord.
The standout example in the memo is CoreWeave, ticker CRWVG. While the chip makers bled, CoreWeave jumped 12% during the regular session.
Let's look at their fundamentals, because they are wild. They doubled their quarterly revenue to roughly $2.5 billion.
But the figure that seemed to set the market on fire wasn't their revenue, was it?
No, it was a $104 billion order backlog.
$104 billion. An order backlog of that magnitude is almost unprecedented for a company of that age.
It really is. Because CoreWeave doesn't build consumer software or individual graphics cards, they build massive, hyper-specialized data centers known as AI clusters.
So they are building the actual buildings?
Yes. They acquire the land, secure the industrial-scale electricity, install the liquid cooling systems, rack the chips, and then lease that computing power to other companies. They provide infrastructure as a service.
I want to focus on the physical reality of that for a second. Fulfilling a $104 billion backlog is not a matter of writing better code.
Or shipping boxes of software, right?
That is heavy industry. That requires pouring concrete, building gigawatt power substations, and, navigating local zoning laws.
That is the exact transition the market is pricing in. The memo refers to them as utility for the 21st century. Investors realize that artificial intelligence is no longer a purely digital phenomenon.
It is bound by physical constraints.
Exactly. You cannot run a next-generation AI model on a laptop. You have to rent space in one of these massive clusters. Therefore, the company that owns the physical infrastructure, the power, the cooling, the servers, holds the ultimate leverage.
They aren't selling you a car, they own the only highway, and everyone has to pay the toll.
That's a perfect way to look at it. And this transition isn't just an American phenomenon.
Right. The memo highlights a company called Nebius Group, ticker NBIS, which jumped over 5% after hours. The catalyst for their surge was the expansion of sovereign AI clouds in Europe.
Sovereign clouds are a huge theme right now.
What exactly makes a cloud sovereign?
Data sovereignty has become a critical national security issue. European nations realized that if they rely entirely on American tech giants for their artificial intelligence infrastructure, their national data is subject to foreign corporate policies.
And potentially foreign intelligence laws.
Right. A sovereign cloud means the physical servers are located within the borders of that specific country, governed exclusively by local privacy laws, and operated by a domestic entity.
So a government like France or Germany is effectively saying, we cannot have our national defense algorithms running through a server farm in California.
Right. Or governed by a Silicon Valley terms of service.
Yeah, that makes sense.
Or, subject to U.S. federal subpoenas. Nations are rushing to build their own isolated AI infrastructure, which requires massive upfront capital.
Which ties directly into another mover on the memo, Cerebras Systems, ticker CBRG. They bumped up a couple of points on a partnership to build next-gen AI factories in Asia.
Notice the language there. The language across the board has shifted from software to heavy industrial terms like factories, clusters, and sovereign clouds.
We have spent the first half of this deep dive talking about hundreds of billions of dollars sloshing around in corporate tech budgets.
Yeah, landlords, massive industrial factories, just infinite sovereign spending.
Right. It paints a picture of an economy flush with endless capital, but the internal broadcast notes force a very harsh pivot away from this high-tech euphoria.
They really do. It brings the anchors back to the physical economy that you and I actually live in.
The contrast is honestly jarring. You have companies reporting $100 billion backlogs on one page, and on the next page, the memo focuses on something they call the inflation squeeze,
detailing how the everyday consumer is completely tapped out.
Let's lay out the macroeconomic data from August 2026. The Consumer Price Index, which tracks inflation, is sitting at 3.4% annually.
And the 10-year U.S. Treasury yield is hovering around 3.9%. The anchors are instructed to frame this as a Goldilocks scenario for the Federal Reserve.
A Goldilocks scenario.
Yeah. In the realm of monetary policy, a 3.4% inflation rate combined with a sub-4% Treasury yield is considered manageable.
Not too hot, not too cold.
Exactly. It indicates the economy isn't running so hot that the Fed needs to aggressively hike interest rates, which could trigger a recession, but it isn't so cold that we are facing deflation. On a macroeconomic spreadsheet, it looks like a soft landing.
But the macroeconomic spreadsheet does not reflect the reality of buying a cart of groceries?
No, it certainly does not.
The anchors are instructed to highlight the pain in the retail sector. While the tech sector soared almost 2%, consumer staples were the day's biggest losers. Target and other non-essential retailers are showing severe weakness.
Because consumers are hurting.
I think we need to explain the mechanics of disinflation here, because when people hear inflation is easing, they expect things to get cheaper, and that is fundamentally not how it works.
Disinflation is one of the most misunderstood concepts in economics. When the inflation rate drops from, say, 8% down to that 3.4% Goldilocks number, prices are not going down.
Right.
The rate at which they are climbing has simply slowed.
So if a family's weekly grocery bill was $100 and it suffered an 8% inflation spike, it costs $108.
Yes.
When inflation cools to 3% the next year, the bill doesn't go back to $100. It compounds. Now it costs $111.
Exactly. The damage from the previous spikes is permanently baked into the price of the cereal.
And that compounding effect over 3 or 4 years means the average household's baseline expenses, rent, insurance, food, have basically consumed their entire disposable income.
So when it comes time to buy a new television or upgrade a wardrobe at Target, the consumer simply abstains. They are economically exhausted.
And the market behavior reflects this exhaustion perfectly. The institutional money is ruthlessly abandoning anything tied to the slow-moving consumer.
But they are also fleeing defensive stocks.
Right. The memo highlights utilities as the absolute worst-performing sector of the day, down 1.4%. Why are investors dumping utility companies? I mean, people still have to pay their power bills regardless of inflation.
Utility stocks are traditionally treated by investors as bond proxies. You don't buy a utility stock expecting the company to double in size. You buy it for a highly reliable, steady dividend yield.
Kind of like clipping a coupon on a government bond?
Precisely. But in a market where you can get a guaranteed 3.9% yield on a risk-free treasury, or you can chase massive, explosive growth in companies building AI factories.
The slow and steady utility dividends suddenly looks entirely unappealing.
Capital flows to the path of highest return.
So the money is flowing out of the safe, boring power grid, and it's also flowing into traditional fossil fuels. The memo notes energy was actually the best performing sector of the day, up over 2%.
Driven by a domestic stockpile drawdown and news out of the Middle East.
Right. When domestic crude stockpiles drop unexpectedly, it signals that demand is outpacing supply, pushing the price per barrel higher.
Combine that with geopolitical instability threatening supply lines in the Middle East, and energy becomes a highly attractive momentum play for institutional capital. They are chasing the immediate catalyst.
Which leads me to a fundamental question about the durability of this entire market structure.
Okay, what are you thinking?
We have an S&P 500 hitting all-time highs, powered almost entirely by tech companies hoarding chips and building $100 billion infrastructure projects. At the exact same time, the actual human consumer is tapped out, refusing to buy discretionary goods.
The divergence.
Yes. If no one is buying the t-shirt at Target, who is ultimately paying for the products that these AI clusters are supposed to be inventing, can this divergence between Wall Street and Main Street actually last?
Historically, a divergence of this magnitude cannot last indefinitely. Ultimately, all corporate earnings lead back to an end consumer.
Right. Eventually, someone has to buy something.
The companies leasing space in CoreWeave's AI clusters are doing so to build software, automate customer service, or optimize supply chains. They need paying customers to justify those multi-million-dollar leases.
And if the broader consumer base is completely hollowed out by compounding inflation,
the revenue models for the companies renting the AI infrastructure will inevitably collapse. The infrastructure is being built for consumer demand that might not actually exist.
wow. So to synthesize what we are looking at in this August 2026 producer memo, we are seeing the internal anxiety of a market caught in a massive transition.
Definitely. Investors are rotating out of consumer-reliant retail and ditching safe utility stocks.
And they are demanding extreme physical scale from the technology sector. The narrative has completely matured. The days of buying a stock just because it mentions artificial intelligence in a press release are over.
Breaking revenue records is no longer enough. The institutional money is now hyper-focused on the physical deployment of this technology, the sovereign clouds, the cooling systems, the actual factories.
Which leaves us with a final, pretty fascinating paradox to think about. We discussed how capital was ruthlessly fleeing traditional utility stocks during this session.
Right. Investors decided the companies that managed the electrical grid were too boring, too slow, and not worth their money.
They sold off the power providers to chase the AI infrastructure boom.
Yes.
But we also established that fulfilling a $104 billion AI backlog requires industrial-scale gigawatt power substations. These AI factories are incredibly power-hungry.
You cannot cool tens of thousands of advanced processors without drawing massive continuous electricity from the grid.
Exactly. So Wall Street is aggressively dumping the utility companies while simultaneously pouring hundreds of billions of dollars into AI clusters that fundamentally rely on those exact same utilities to function.
It's a huge contradiction. The energy demands of liquid-cooled AI data centers are orders of magnitude higher than traditional software server farms.
No. As these factories expand, at what point does the physical limit of the neglected electrical grid become the hard ceiling for this entire technological revolution? I mean, it doesn't matter how smart the AI is if the local utility company can't generate enough power to turn the servers on.
It really is the ultimate bottleneck. We are racing toward a digital future, but we are completely bound by the physical constraints of analog infrastructure.
Something to keep in mind the next time you use an AI tool. Think about the massive, power-hungry factories grinding away to generate that response, and the deeply conflicted market trying to figure out how to pay for the electricity.
Such a great point.
Well, that is all for our deep dive into the internal strategy of bulls, bears, and the bell.
Thank you for listening, and always remember to look past the headline numbers.
We will catch you on the next deep dive.